Welcome, Propy 128. It's Adam here with Propy. I've got Federico Montoya from Synergy One Lending up in Colorado, Denver, Colorado, with us today. This week, for the first time in over a year and a half, we're talking rates. We're talking what does the new normal look like? We're talking ways that realtors could get creative to get rates into what buyers might find to be feasible. Every conversation I have with realtors, it feels like the rates come up more than ever. Federico, is that the same for you and your case?
Yep, that's definitely the forefront of everyone's mind. What are rates doing? How is it affecting affordability? All those things, right?
The last couple of years when rates were at all-time lows, nobody wanted to talk about it, but now everybody's talking. Do they blame you at all, or do people know how the Fed works and you don't have any control of the rates?
Very few. Luckily, I've had very few customers blame me. I'm not quite sure sometimes. Where their frustration is really focused, but no, for the most part, I'm off scot-free on that.
So those who don't know, Federico has worked with Anna, our VP of Title, for a long time. Federico and his group use us here at Propy Title and Escrow, which we appreciate that business, especially as we're kind of growing in our traditional footprint. But I think, sometimes we talk about a lot of emerging technologies and we kind of get all over the place. But if it's okay with you, Federico, what I'd like to do is maybe just talk about some traditional pieces for realtors as it relates to lending, ways they can be aggressive in terms of maybe buying down rates or arms, things that a lot of realtors have never had to deal with. That I'd like to talk about where you think the market's going to end up, what the new normal looks like. I'd like to hear your opinion on, affordability and how that goes in terms of equity still seems to be staying pretty strong. Rates are rising. Where does that put us in terms of the affordability index? And so we've got a lot to get into, but before we kind of get going, maybe you want to give us a couple minutes on where rates are today and what you think they're going to be in the near future and maybe mid to long term.
Sure. Yeah. Rates today, 30-year fixed, recently as of Monday, hit a 20-year high, slightly over 7% based on the daily rate survey that I follow. That 20-year high is that's a tough swallow, right? As far as the Fannie Mae, Freddie Mac, FHA rates, but one thing that's interesting, we saw quite a large increase since the beginning of August when rates seem to be settling down. What that's been driven by is the strong economic indicators, in the market. We're seeing, August still had strong spending, strong business spending, strong home sales still, and those things are still keeping rates high. As far as what we're seeing for the future, I mean, luckily today we're seeing the market down a little bit. Probably average 30 years just maybe in the high sixes now as of today, and that kind of happened more this afternoon. We're seeing a strong bond market today. People maybe pulling back a bit on selling. So from that standpoint, future-wise, I would say, the expectation, everyone's going to be watching the economy real closely over the next couple of months to see when the Federal Reserve meets in November. What are the indicators showing? Are they going to raise rates again? And if so, what will that effect have on mortgage rates? I think in the short term, we're definitely looking at rates in the high sixes to low sevens from now until into next year. In spring, if the economy is really slowing down, it appears to be at least, on the forefront of the housing market. That could have an effect on the stability. Originally, Fannie Mae predicted next fourth quarter next year rates to be back in the fours. That might be a little optimistic, but definitely you could see that happening. Based on my opinion. Maybe rates back in the fives, in the 30-year fixed, maybe mid-five. Which would there's a big difference between that and the 7%, right? And just psychologically, what that means, for buyers. and sellers.
Well, I think especially as you look at people who may have been in the market a while, but if I wasn't in the market the last 3 or 4 years and I get back in the market, it may just seem normal to me. I think
Yeah,
time flushes a lot of expectations. The concern I do have a little bit is, rents are still really high all across the board. Equity is still really, really strong. Typically, when you see rates spike is probably an aggressive word. When you see rates increase, you see price values come down, but it's like a three-headed monster. Rent's high, rates are high, equity's high, and so I think it will be a little bit before the market comes back to some normalizations. The thing that I will tell you though is people still need to buy houses. People are still being transferred. People are still having babies. People are still getting divorced. Like we're not going to go from 6.5 million homes sold to 3 million. Like we know the number is going to be
sure.
somewhere between 4.5 to 5.5, whatever it's going to be. And so that's where I think a lot of realtors, as you work with realtors every day up in Denver, like what are some tips and tricks that you're using for realtors? Maybe one, to set expectations of buyers. Two, do you have to temper prices of sellers? And three, what are some ways you can kind of get creative to maybe get that payment conscious buyer into the right payment?
Sure. Yeah, I mean, first and foremost, we've seen quite a bit of market volatility over the last couple of weeks. And the idea is to, keep in touch with agents and buyers very closely as rates change and how that affects their purchase point. The main product that I'm focusing on more than ARMs, because ARMs are not pricing out all that well, conforming ARMs at least, compared to normal 30-year fixed, unless you're talking jumbo. Jumbo ARMs there's a benefit there in rate for sure. Is the 2-1 temporary buy down that allows to pay an amount up front to bring down the interest rate by 2% from the going note rate at the time of lock. So let's say if rates were 7% today, the first year your payment's based on 5%.
Just for the first 12 months?
For the first 12 months. Second year, your payment's based on 6%. The good thing about that product is that money goes into like a deposit account with the lender. So if you were to refinance before that money is used over the 2 years, that money is still in an account there and can be used to reduce the principal balance and pay it off on a refi. It's like a full buy down. If somebody were to buy the rate down from, let's say, 7% to 6.25%, and let's say rates were to drop in the next year to 5.5%, and they wanted to refinance, well, that money they pay up front is a sunk cost, right? It's gone. Whereas on a temporary buy down, you don't lose that. Of course, the risk is that rates don't go down in the next 2 years, and then you're going to be there with a 7% payment. But the benefit overall is, there's different scenarios, right? What if somebody sees their income going up in the next couple of years? To start a job that has great prospects for future earnings. What if last a couple of years that maybe one of the parents and one of the borrowers got a job market to take care of them. In the future, maybe have to possibly 10 months because I don't know what to take. Maybe the one's going to get to work. We don't have 2 windows. Well, 201 ease into that, right? You still have to qualify. They're qualifying based on their income. They're qualifying on that 7% rate payment, right? So it's not like one of those old products from 2007 and prior that were, you're qualifying off of something that doesn't really exist. They still have to make enough income to qualify for that 7% payment, but they get a lower payment than usual.
So Federico, let me ask you this. So if I'm a realtor, how do I figure out what a 2% temporary buy down is? Is it a percentage of total list price? How does that work?
Yeah, it's a percentage of the loan amount based on the rate that day. I typically give agents a range, right? Like, hey, if the loan amount is going to be 600,000, the temporary buy down is going to be, you know, almost 14,000. I give them a range. Now, I have a calculator. I've shared that with the agent. It's basically the difference. It's the difference in the monthly payment at the 2% reduction and then at the 1% reduction, all added up. The money is paid for up front. It's not like you get a discount or anything. All the savings is paid for up front. However, you negotiate to be paid by the seller through a concession. It can't be paid for by the buyer or the borrower. It has to be paid for by the seller, by the agent, or by the lender by pushing the rate up.
And if you just use the full amount over the 2 years, you break even. If you refi in the meantime, you come out ahead. So there's
Correct.
very little risk for the borrower, and the seller just writes it up as a concession, especially in a market where we're going to get back into having concessions. So
Right.
kind of a win-win.
Yeah, sorry, it is a win-win. And we are seeing a lot of concessions here in Colorado, in the Denver area, I should say. I think, based on other markets, things are still strong in other markets. I think we are seeing sellers more flexible, at least here in the Denver area, and I think that could be coming to other markets also.
Yeah. I was in Denver last week. I presented to the DMAR. We had a class, our first ever Propy certification class there with Shelly Vincent, the XP broker, and Nobu Hata, the president of DMAR, came and spoke. So we were just there at their office last Tuesday. So it was a good session. So what are you seeing in terms of, I mean, for me, the big data point is how many mortgages are applied for year over year, month over month. What data are you seeing in terms of mortgage applications? Is it still down significantly year over year? Or do you follow that?
Yeah, I do follow that. It was down, June and July. However, it was up in August, and I think that could be attributed to the lower interest rates we saw kind of for a short period of time at the beginning of August. Unfortunately, data that we get like that is usually a month lag, right? So we don't know what September looks like, but I can tell you, as a region, and I'm in touch with our region, which includes Utah and Colorado, our applications were down.
Right.
Well, our closings are significantly down for September. Applications and loans going into October are further down month over month, and definitely refi applications.
Yeah, those are done for a while. I think I read a stat that the beginning of it was February, March, like 75% of Americans either had bought a new house or had refied. So 3 out of 4 homeowners right now are sitting at a pretty good rate. And so, we're all in this game of, we look at a new house, we want to buy a bigger, nicer house, theoretically. What's the payment? What's the value index? Let me switch gears on you a little bit. I would be remiss if I didn't do a little bit of crypto. As you and I talked about off camera, there's really no one out there yet doing a true crypto DeFi mortgage platform for a lot of reasons. But have you guys had any instances where you've come across having to season digital assets, i.e. crypto, for funds for down payment or otherwise? I know you've got a little bit of experience with that. Can you tell us about that?
Sure. Yeah. I mean, over the last couple of years, that really kind of gained steam. And the good thing is that that type of borrower is usually pretty sophisticated, right? And I've had many buyers use crypto by converting it to US dollars to use for that. And being able to season that and document it within their crypto wallets hasn't been an issue. The Fannie Mae allows it, right? So Fannie Mae backed loans allow that. And the documentation isn't as difficult. Typically, we just need something with, usually the wallet has their name on it, right? Doesn't even have to have necessarily an account number. Has their name on it. You could see the activity back for up to 60 days, which is usually what we need. And then we just document the liquidation and the conversion and the liquidation into their bank account. And I've had multiple borrowers that use multiple sources, not just out of one wallet like Coinbase. I've had multiple borrowers be able to document everything. It's just having the conversation up front as to what we're looking for and what's expected based on the Fannie Mae guidelines.
What is the Fannie guideline? Let's say I have X amount of dollars in Bitcoin in a cold storage wallet.
Mm-hmm.
Your recommendation was I take my down payment, put it in some sort of an exchange, whether it's Coinbase, FTX, whatever it might be, move it there.
Mm-hmm.
How long does it have to sit into, let's use Coinbase since it's the most widely accepted. How long does that have to sit in Coinbase before it becomes seasoned by Fannie standards?
In that situation, it would have to be 60 days of seasoning in Coinbase. But if we could document it originally under the borrower's name, in some cases we have been able to do that even before it gets transferred into Coinbase. We're able to still use that without any seasoning having to occur in Coinbase, as long as we could show the activity back for 60 days with balances and activity in the account. What Fannie is really looking for, based on lending guidelines, are large deposits, not necessarily. So when you're showing daily activity, as long as there aren't any large deposits in there, it shouldn't be a problem. If there are large deposits, then we have to source where those came from. But it's not necessarily the fact of where the asset is being held. It's just documenting that it has the borrower's name, what the value of the asset is, and then documenting the transfer of it from one to another, ultimately into their bank account, to have it there for down payment.
So that's interesting. That's actually really good information, because most lenders, they do it so rarely and it's so new and unique that they just kind of shy away from it, almost like they don't know. So that's really good data. I would recommend that anybody's listening or watching or listening to this after the fact, if they have any questions, to reach out to you.
Yeah.
I know we've got 3 or 4 minutes. Walk me through kind of what you guys do at Synergy One. It's a little bit unique. If I'm a realtor, in what areas can you help me with, providing service to my buyers and sellers?
Sure. Well, first of all, I'm licensed in quite a few states. I mean, I could do a list, but I mean, you could reach out. I mean, most of the West, part of definitely Southwest, portions of Midwest. So California, Washington, Nevada, Ohio, New Mexico, Arizona, Florida, Virginia. Those are some of the bigger ones. I'll just say that. Illinois. Those areas here, obviously in Colorado too. As far as what Synergy One does, we are here, and me personally, I like to problem solve. Right? Somebody comes to me with a scenario, I want to try to figure out what's the way to make it work. Right? Just similar to what we just talked about, crypto, right? Making that work. Talking to them through it. Here's what we expect. And really figuring out together what can be done. And really, it's the products that we have. We do offer a quick close HELOC. We offer that through Synergy One. It's a blockchain HELOC. So we're able to close this funding in as little as 7 days. There's very few other lending companies that offer that product. We are constantly adding products as far as bridge loans, right, and standalone bridge loans. Just trying to have solutions for people that, there's some that, they don't want to move, or they don't want to have to worry about selling to move. Bridge loan is a great option for that. Luckily, we have a great leadership team with their pulse on the street, their finger on the pulse of the street, I should say, and they're constantly looking at new products. And so I would say that, if you reach out to me, I don't have the product, or I could help you find somebody that does. But ultimately, by us knowing about it, we're constantly evolving. It's what you have to do to remain competitive in this market.
Yeah, I mean, absolutely. That's I think there's a whole lot of agents who are going to have to get really good at setting buyer and seller expectations,
Mm-hmm.
becoming knowledgeable in terms of the best loan options out there to be, of service to their clients. I think there's going to be a little bit more skill brought back into the real estate transaction. I'm looking forward to it. So
Yeah.
real quick, yeah, and I also think, listen, I've been saying it for a while, and no realtors have used it. Maybe something good I was saying, but I think there's also I'm looking forward to bringing the joy back into buying. You should be able to look at a house more than once before you have to buy it. You should be able to get a deal on a house that you feel comfortable with, and so I think this new market's going to provide that. And I think there's a lot of value to that. So before we wrap up, I promised I would keep it to 20. We're already 2 minutes over.
Okay.
If I want to reach out to you, if I want to find you, how do I get a hold of you?
All right. My website is in the chat. If you could see that there, go ahead and copy that link. You could email me at fmontoya, F as in Federico, fmontoya at S1L, the number one, as in Synergy One Lending, S1L.com. My phone number is 303-667-9235. That's my mobile number. Feel free to reach out by phone, text, email, go to my landing page, learn a little bit more about me.
What's your guys' website URL?
It's S1L.com.
It's a good one. S1L.com. So anybody looking at this on social, can't get a hold of the chat, Federico Montoya, he's on LinkedIn. I found him there, S1L.com, and he just gave his phone number. So any questions you have about rates, traditional lending, they've worked with our title company to do some crypto wallet deals, seasoning of funds, really knowledgeable, really sharp, way ahead of the curve, especially in a new market where, I think really good mortgage partners are going to be tougher to find because of the last 5 years. I think it's a really good asset to have. So thanks for hopping on with us, and we'll have you on soon.
Yeah, thank you. Sounds good.
Hopefully we talk next time about how the rates have stabilized and maybe went down a little bit.
Yeah, I'd like to see a market like you're talking about, buyers with a little bit more flexibility on seeing a house, right?
Yeah.
And making an informed decision instead of feeling rushed, right?
Yeah,
There's a lot to be said for that. There's a lot to be said for that.
And we bought this house and it was stressful. It wasn't fun. I mean, to be able to look at 3 or 4 houses, I don't know, it'd be crazy to have to look at it more than once before I had to make an offer. So,
Right.
Well, cool. It was nice catching up with you. We'll be in touch soon. And if anybody watching this now live or on socials later have any questions, don't be a stranger. Reach out to Federico and his team. They'll take care of you.
Thank you.
Thanks, bud.
All right, we'll see you.
See you guys.
All right. Thank you, everybody. We'll look forward to seeing you on Propy's next webinar next week. Same place, same time, and live on social media.